Welcome to Fintechs Fair, your go-to source for in-depth analysis of the most impactful events in the fintech world. Today, we're exploring how fintech companies like Nubank are setting benchmarks for IPO valuations, while also examining why comparisons between Nubank and its counterparts like Revolut might not be as straightforward as they seem. Nubank, the Brazilian fintech giant, has become the prime reference point for digital banks aiming for public listings. It's one of the few digital banking groups globally that is both listed and profitable. Its shares have surged over 60% above its IPO price of $9 a share, currently trading at 32 times its forecasted $2 billion earnings for 2024. That's an impressive feat, setting it apart from many neobanks that still struggle with profitability. However, while it may be tempting to use Nubank as the standard, the comparison isn't so clear-cut. Take Revolut, for example. Even if it matches Nubank's impressive revenue growth, it would only reach a valuation of around $33 billion, significantly below its current $45 billion estimate if we use Nubank's metrics. Looking forward to 2026, Nubank trades at 16 times its forecast earnings. Applying this to Revolut shows a tough road ahead. Revolut would need to generate almost $3 billion in net profit in 2 years to justify its current valuation. This shows how important it is for fintech bankers to look beyond Nubank when valuing European and North American neobanks. Nubank operates in a different environment, a domestic market that has been uniquely conducive to its growth. It offers credit cards to people who may not qualify for loans from traditional banks due to inefficiencies in the legacy system. This allowed Nubank to capture 10% of Brazil's credit card market in just 5 years. Its revenue grew by 68% in 2023 alone, and estimates suggest another 40% growth in 2024. Nubank's operations are also shaped by the higher rate environment in South America, with its net interest margin reaching 18.3% in the last quarter of 2023. In contrast, Revolut, operating in markets like Europe and the US, reported a much smaller margin of around 3%. Another key difference is in their revenue models. Nubank generates 80% of its revenue from interest income, which comes from its core lending operations. On the other hand, Revolut relies heavily on fee-based income, with transaction fees and foreign currency exchanges making up most of its revenue. This fundamental difference makes direct comparisons challenging. So while Nubank serves as a popular benchmark, it might not be the best fit for fintech companies like Revolut. Fintech bankers prepping for IPOs must get creative. For instance, they could switch valuation metrics. Revolut has used enterprise value relative to sales in earlier funding rounds, a measure more suitable for unprofitable startups. Alternatively, bankers could explore comparisons with other listed companies. For example, Adyen, a $48 billion Dutch payment group that generates most of its revenue from fees, trades at 32 times its 2026 earnings. This figure is much closer to Revolut's business model and could serve as a better benchmark. If Revolut's earnings reached $1.9 billion by 2026, it could justify its $45 billion valuation. But not all neobanks could apply this strategy. Monzo, Oak North, and Starling Bank, which rely more on interest income, may find it harder to make that comparison. While Nubank's growth and success are impressive, they don't tell the full story for every neobank. Don't forget to like, subscribe, and hit the notification bell for more expert insights into the evolving fintech world.